Welcome to Market Buzz. I'm Greg Schnell, the Canadian technician and host of the Market Buzz. Each show, we do a deep dive into different industries using weekly charts to see what is happening on a long timeline. Please follow me on Twitter at Schnell Investor, and you can also find my blogs on ospreystrategic.org as well as StockCharts.com. So, have we seen this before? The market's starting to roll over here, and there's a lot of questions out there. I'm particularly concerned here, and one of the things that I think is helpful for people investing in the market is to understand the macro. And so each week I go through all the different asset classes to try and get a feel for what's going on across currencies, stocks, commodities, and bonds. And what we're looking at here is something that we have seen before, and I want to try and lay it out a little bit more clearly to help people realize the importance of the market. Now, my investing style is start-stop, and a lot of people are buy and hold or swing trader or whatever. So there's different approaches to the market, but what I want to set up here is the reason that this market could be in for a lot more pain than we've currently seen, and it may not work out this way, but what would be more important is that at least you knew and had the choice if it does pan out, and we have seen an example like this before. So the current market conditions, and the market obviously on Tuesday broke down pretty hard. So we're going to go through a lot of charts here and just try to cover it up. I'll go through all the charts in my recession watch list. I've been doing this more than I expected to, that's for sure, over the last year and a half. But let's jump into the charts. Let me just close this. And what we see here, this is a chart. Again, the chart list is called Recession Watch. And what you'll see here is, here's the S&P 500 earnings. And what happens is the green line is if PE ratio was 10, if PE ratio was 20, if 15, and the red is PE ratio of 20. And we're currently sitting with a PE ratio, this purple area here, we're call it 4,000 is where we're at on the index. But what happens is that's got us at a price earnings ratio of 21. And we're still very, very high. And so a lot of people don't think the recession's coming. And I think we're in a bigger position here to be more focused and be aware of what's changing around us. So one of the things that's going on is the Clerical Workers Index has started to push to a higher high here, but we are getting a PPO sell signal on that. So the wages might start rolling over here. We'll see if that follows through or if it breaks out to a higher high. But typically that's a good place to just be aware of that is changing. Now, I've mentioned this Fed funds rate so many times. I don't want to repeat myself, but it's a real part of the story. And so I think it behooves me to make sure that everybody's understanding what we're talking about here. So the Fed started to change interest rates a year ago. It takes roughly a year for the macro environment to change to the changes that the Fed makes in interest rates. What we've got is that we made the single biggest move on this chart by far in terms of interest rate changes, where we went from 0.15 and we soared all the way up to 4.5. And the expectation was we were going to top out in the low fives. And that is now starting to change as the inflation data came through in the last few weeks. So the picture here is getting much different. And the point I want to make is this was the rate of change in 1 year. This is the 12-month rate of change. And what we see here is we typically don't get up that high. We get maybe a 200% increase. So it would have doubled in 1 year. But what's particular happened this year, also in the shortest period of time. So if you look at the slope of this increase or this increase, these took a period of time to do, but never have we done it at such an accelerated rate. Now, even if you took the interest rate and changed it from starting at 0.15 to starting at 1, it wouldn't make this number look, or this chart look quite as dramatic. But we still have the situation in the backdrop where mortgages are changing quickly. If you want to buy a new house and go sign up for a new 30-year mortgage, it's dramatically different. And so people, I don't want to say are locked into their current house, but because this changes so fast, it's really affecting a lot of things. Now, in the middle is my momentum change chart, and what that shows, that's the PPO, and what we see is each one of these is getting wider and wider and wider. And what worries me is, again, we're going to go way up here with probably another at least full percentage point increase, was kind of the way it looks, between now and say September. And what we're looking at is, as this is running up, we're getting up to the level where basically we had the housing problems in 2007. And one of the things that happened, remember, everybody had we had hairdressers that had 5 houses because they were renting them out because they were making money on property. And low interest rates have allowed this to kind of go on. But the problem is, as the interest rates go up, now we need to sell those houses to somebody. And if you can't make the payments, or if your renters can't make payments based on this increased amount, then you've got a secondary problem, right? And the problem is you can't sell the house because there's nobody lining up to buy them. And the reason they're not lining up to buy them is because the new interest rate is too high. And yet you've also got this problem where you can't, the interest rates are working against the current owners. So the pressure goes up in the marketplace as debt goes higher. So it is this key change, this rate of change, that I think is going to be the unlock for what has been a relatively bullish market. And again, COVID changed a lot of things, and we went through a lot of these wild cycles. You can see the PPO from 2009 to 2017 went from bottom to top. And here we are in 1 year. We've literally made that same move that took 8 years to make that same sort of change. That's the kind of change I'm talking about, and why I think it's critical for us to not just sit on our laurels and expect things to work out really well. So this is the housing new single-family home sales. And what you see is this chart's been breaking down, and clearly it's below the green uptrend line. Now, again, we saw that in 05, 06, 07. We saw it in 85 and 87. So we've had these periods where housing, as the interest rates, and this is where the Fed was, Paul Volcker was trying to fight high inflation. So he that was his big goal here, was to kill inflation. And what you saw is this came down meaningfully hard, and we're seeing this now, but we're also just setting up here where all of a sudden the interest rate changes, where people were pricing in, tops around 5.25 are now pricing in tops higher than that. And it has literally shifted from maybe 1 more this year to 3 or 4 more this year, and that's a dramatic level of change. So anyway, on the single family home sales, we see this line breaking. Now, if we go to housing starts, so this is new homes in the ground, what you see here is this is also breaking. And we had a brief bust with COVID, and then the Fed came in. Well, the problem is the Fed's not coming into our rescue anymore. And if I just took a chart and said, what's our PPO doing? Well, it's just moving into negative territory now. And again, that was kind of how we started the housing bust in 06, 07. So some people might say, well, we probably got another year then before we have a problem. Well, the other side of that is, because we've changed the interest rate so fast, unlike that period from 03 to 07 where the Fed was changing rates before, this looks to be more problematic. So I think what's happened in housing is that, and if we just go get an XHB chart, and we'll just pull up a weekly version. What I want to show here, so you have your original peak, and then you come back and you make a lower high. But in momentum, what happened was you had this big peak, we come up and we just get to 0, and then we roll back down again. And it's on that roll back down again, that secondary high, that's where we really need to be aware that something has changed. And that's what I think we're staring at for housing. But again, housing's just one part of the equation. So, just if we had a rotating issue in housing, that wouldn't be totally bad. Now, here's industrial production, and this goes back to the January read. But you can see it's pretty hard to get industrial production to roll over. And yet somehow we've managed to really hammer it home here. And again, we've just got a PPO sell signal. Those are not really friendly for the market when we get these big sell signals. Like, it's okay if the PPO goes flat, but we clearly are breaking down through it in a meaningful way. And so again, the first was housing. Here we are with industrial production, so way different. And then when we look at bigger charts like the banking sector, what I try to show by this chart is we had a big giant uptrend. I agree, COVID was kind of a one-off weird deal. And so we broke that uptrend, no big deal. But here we've broken it. And now we're coming back and we're getting back to around the 40-week moving average. And the real question is, can we keep going? And if so, that's perfect. But here's the problem with our analysis. If the PPO rolls over at zero, and we don't know if it will, but it is definitely starting the week with a bit of a down tilt. And then what we don't want to see is this whole thing kind of cycle down. And that's what happened back in the 08-09 period. And I don't know if I can get more data on this ETF. Yeah, I've got a little bit more. So our PPO started to go below zero, then tried to rally. And then on that rally, it failed and then failed again. What I think is going to be our problem here is if people can't afford the payments they currently have. So as an example, they go in to get a new car and the car is at a different price point. It's both the car prices are now higher and the interest rates are higher. That changes how many people can afford new cars. We have that same issue in houses. And so all of these big purchases, we're starting to see it show up in durable goods like appliances, non-durable goods. So we're starting to see it show up. And then what we want to be aware of is the big macro picture, right? Just, okay, well, we know we've got a broken trend line. Now we really need to start the uptrend. Well, what if the uptrend doesn't start? And that's a real point that we need to keep in the back of our mind. Okay, so railroads are another one I like to watch, and I will just say I picked railroads. The chart looks awful. And you could just see the declining trend here on the PPO momentum. And this isn't a very good look, right, when we kind of break down like this. So the railroads having a PPO below zero is not a good look. Now, trucking looks better. So you'll see the trucking way up high here. This is weekly, and I can just go back 15 years. This one actually tracks the S&P pretty closely. So I will be the first one to say it looks much better. Now, the real question is, do we just top out at a prior high? And so that's why I've drawn this line on here. So as things started to turn up, perhaps trucking could take over. And it could be just due to the low price of diesel fuel that trucking, because it's come off the highs, that this trucking chart looks better. But that's the good news here in this recession chart list. Now, if we go to the Dow Jones World, what we have is we have obviously the big trend and then the roll down, and then we have an uptrend here, and we're just starting to break that uptrend. So if there was a place that's, again, global index, big picture, what we don't want to see is this start to roll down. Now, this has been a 5-month rally. If we're going to start breaking it, it's at least a place on the chart to be careful. I think we're there. Now, there's a lot of crazy stuff around the bonds, and what we've seen is this is a chart of the 3-month to the 10-year yield, and you could flip it over and have the 10-year to the 3-month, whatever. What I did was, by putting the 3-month before the 10-year, when this spikes and then starts to roll down, that's when you enter the recession. And so this really is, let's just call it, still going into outer space. But one of the things I noticed, the one in 06-07 was a relatively slow rollover. In 2001, this thing started to literally like a knife. It just kind of reversed hard. The one in 1998 also just kind of reversed hard. And then we had the 1990-1992 recession. So this indicator doesn't really give us a rollover typically. Now, the last couple of times we've had the Fed involved, so maybe it hasn't been quite so sudden, but you can see that there's some pretty big church spires on this chart. And if we're going to roll over quickly here, Again, we're right up around that 06, 07 level where we kind of got to before the whole thing unwound. And again, the reason that that's a good comparison is because that's when the interest rate by the Fed was similar to the interest rates that we saw this time around as we accelerate. So let's look at the whatever. I could do the 10s, 2s. They all look the same. These charts are all set up for something really significant to happen. So here's 2000 where this is the 10-year minus 2-year, and we got down to this low level. And it was actually when it started to reverse higher that it was a big problem. So here's the question. Is that starting right now? Still too early to say, but one of the things we know is when this starts to invert or revert back to a normal direction, typically the stock market hasn't topped out until the recession is well over. Well, the question here is none of this stuff has started to trigger yet. So what we've seen is just an early stage decline out of a bigger, what would be considered recessionary decline. And if you look at 2000 or 2007, we got below the zero line and stayed there for months. I don't know if we have to wait until it gets above the zero line. I just don't know. But again, I think once this starts to reverse from a very overdone position, and the year 2000 was like that. In the year 2000, as this bottomed literally in March 2000, the stock market topped. And what we saw here is, you know, if we're going to get this change in direction, this could be relatively sudden. So it's at least something to watch. Now, I could go through a whole bunch of more of these yield charts, but you get the idea. They're not exactly set up for success ahead here. Now, the personal consumption is a really interesting chart because we have the PPO going on a sell signal now. And again, everybody's talking about, you know, retail is going to be fine and stores still have money and all that kind of stuff. I think what we're finding, why this chart is starting to roll over already, contrary to the news, and again, the news is not a very good trading entity, is that what we're starting to see is people are making decisions, whatever, it's a car payment or their mortgage payment, whatever was on a variable rate loan, or they've been laid off and living on credit cards for a while until they got a new job. We're starting to see those debt proceeds or positions push into the market and start to make charts like this consumer personal consumption expenditures roll over. So again, it's not widely held, but I like to look at the momentum indicator. And if you look at 2000, 2001, this is when it rolled over. 06, 07 is when it rolled over. And so everybody says we have more time. And I did a big presentation to my clients, and I talked about driving through a snowstorm. And the issue was each one of these snowbanks that we were going through was a really difficult road home, and we didn't know if we were going to make it, and we pushed and we got through, and then we went on another smaller road and we pushed and we got through. This was back in the 70s, but it's a real example of what's happening in the market here. Each one of these charts are a snowbank that we're trying to work our way through, and the problem is we don't know if we're going to get stuck in one. So is it housing? Is it personal consumption? Is it expenditures? Is it industrial production? Is it the railroads rolling over suggesting demand is weakening? Is it the Maersk shipping line saying they expect their profits down 80% this year? Is it Walmart saying, you know, we expect lower profits and revenues this year? All of this is adding up, and again, it's one chart by one chart by one chart, but it all makes us want to watch or need to watch. Now, I've got the unemployment claims, and I've shown it inverted here, and it still looks okay. What would have to happen here is this chart would have to come crashing down. Now, you can see it did this before in COVID, and we had this big uptrend, and essentially as long as we stay above the green line or around the green line, we're pretty good. But all of the big recessions started with this really rolling over. Now, the question I have is based on the sudden change of interest rate vertically up. Do we have the same problem with all these charts starting to crack, I'll call it, more suddenly on the way down? That I don't know. We haven't played it out like this. But again, we've never had a Fed move this aggressively. So is it housing? Is it unemployment? All of these things are starting to at least, this I would say looks like a topping structure. If I was on some other chart, that's what we'd call it after a big move up like this. But again, it hasn't topped, hasn't started to roll down. So that chart still looks okay. Now I do want to go and show a few things from a different chart. And what I want to show you is, actually I'm going to go get a picture. Whoops, get a picture. And what is this picture on this chart is of two different stock market charts from StockCharts. One is current and one is historical. And what we see here is a big pull down, price rebounds and makes a big rally up and then starts to break down, and then it comes down and rolls down, and I think we've all lived through that, right? We've just seen this. So what we've got here is the PPO momentum is really strong, then it's weaker, and we start to come apart. And then what gets interesting is right here is we have a low, and then we make a higher low on momentum but a lower low in price, and so the market rallies and we all think we're going places and it should be a great thing. One of the critical areas to watch for is as it approaches zero, does it lose that momentum again? And typically if you go back and look at these bear market rallies, they get up around zero and then they roll back over. So in this particular case, this is 2002. This is the current S&P 500. So this was the S&P 500 in 2002. And then what we've got here is the market setting up, and I think these two charts are identical for almost all different ways to look at it. The full stochastic is already rolling over, and this was before Tuesday's drop. And then here we have the current PPO right up at zero, sitting right around the zero level. You can see this double bottom that we made in momentum, same thing we made back in 2002. And then let me show you how that chart ends up. And what we did, I think it's here. Yeah. So this is the current situation. And then if I unwind this chart and just go back to 2000 to 2003 dash done. And what you'll see is we're right at this red arrow. And so to me, that's a big problem, right? We literally come up, we try to make a higher high, we get all of the same price pattern, we run out of momentum right here, the full stochastic starts to roll over, and then the market really kind of figures out that we got bigger problems ahead, and this actually slides down for the next 4 or 5 months, and then we try to base and work our way out of the hole. Now, I don't know if it'll play out that way. Obviously, we're just at a point in time, but literally we just poked our head above the 40-week moving average. We got stranded here for 3 weeks way back then, and we started to roll down now. If I go to that same chart today, what you see is we've spent 6 weeks. And so it's been a little longer. And, I saw one chart on Twitter and it was, well, if we spend more than 18 days above the 200-day moving average, then we're definitely in a bull market. And I was just thinking, it's not how the market works. What happens is new things come into the play and then we have to watch. So to me, the market looks like it's setting up to break down here, break down meaningfully. And we've got a whole bunch of things on this recession watch list that are literally rolling over or have already signaled, like the housing market and that kind of stuff. So with that, I don't want to scare you. I want to set up the charts. The charts are what we're talking about. And then try to think about how we're positioned. So if I don't know if it will happen, if this chart ends up falling for 5 months and makes new lows and all that kind of stuff, have you prepared your portfolio? And the main reason I say that it's important to think about now is those yield curve charts where once they start to to revert, not invert. They're inverted now. Once they start to revert back to getting closer together, when we start to see that, that's probably one of the more typical or critical times in the chart that we need to worry about. And so with that, I'm going to leave you with, we're sitting right there. If these charts all started to revert right here, right now, at least we saw it coming. And so it gives people a chance to prepare. If it all works out differently, that would be great. But I just think the yield charts are telling us that things are way too soon to say that this problem is over. And if anything, the rate of change by the Fed suggests to me it's not going to be over because it was just too sudden. So with that, thanks for taking the time to join me on Market Buzz. Market Buzz airs Wednesdays at 10:30 a.m. Eastern Time. You can also see the recording on StockCharts TV YouTube page. Thanks, everybody. Bye-bye.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.